Hey everyone, in this video I'm going to update my recommendation for Cloudflare stock. I had this company rated as a hold coming into its latest quarterly earnings update. So I'm going to consider those earnings, reevaluate the stock, and answer if now's the time to buy the stock, keep it as a hold, or if it's time to sell the stock. So let's jump into the results.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So in its latest quarter, in the fourth quarter, revenue totaled 362.5 million, which increased 32% year over year. For the full year, revenue totaled 1.3 billion, representing an increase of 33% year over year. Cloudflare is expected to continue to grow revenue as it makes it more convenient for hosts operating a website. It also helps in generative AI. Cloudflare, has servers across the world in major cities in closer proximity to end users, which makes the speed of service faster and more secure for a lot of those trying to develop these websites and host these websites. So its services are highly regarded, highly demanded, and its growth is continuing at these elevated growth rates, and that's expected to continue to increase for several years more. The management highlights that their pipeline close rates, sales force productivity, average deal size, and linearity all improved markedly quarter over quarter. The company was happy with its latest quarterly results as enterprises stopped with their spending cut regimes. Remember, late in 2022 and for the most part of 2023, companies were worried about a recession that never happened. Companies cut back costs, they cut thousands of jobs, and they looked anywhere they could to cut spending. And one of the areas they cut is with Cloudflare. They decided not to join with Cloudflare, not to spend money on this service, even though it would improve their services, improve their websites, improve their apps. They chose not to do it just yet. They paused or maybe delayed instead of going forward. So now that pipeline, the deals are closing faster rather than the customers saying, okay, you know what, we'll wait, and closing deals much slower. They're going ahead and converting. They're going ahead and saying, yes, we'll buy it, because businesses are less cautious now than they were in late 2022 and early 2023, as they've seen the economy perform well, even though interest rates have been above 5%. And that's what was causing the fear of a recession. Even though interest rates were that high, the economy performed relatively well. It grew. There wasn't a recession. And so now businesses feel a little more comfortable going ahead with these spending plans and not as fearful of a recession. So along with its increase in revenue, the company improved its prospects for profitability. Its GAAP loss from operations of 42.8 million was 11.8% of total revenue, compared with the loss of 50.7 million or 18% of total revenue in Q4 2022. So their loss from operations improved by about 8 million or about 16% year over year. So the revenue growth is leading to improved profitability, even though they're still losing money on the bottom line. If you've been following my channel for a while now, I say I don't mind companies that are losing money on the bottom line, so long as they're demonstrating that they're moving in the right direction, that as they're growing revenue, it's shrinking their losses and they're moving closer and closer and closer to profitability, which is what we saw from Cloudflare in its most recent quarter and its most recent few quarters. More importantly, cash flow. Cash flow from operations. I want you to understand the importance of this metric. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, Two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of % annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. Okay, so now that you've considered what cash flow from operations means, look at Cloudflare. Net cash from operating activities of $85.4 million compared to $78.1 million for Q4 of 2022. So positive $85 million and improving. Free cash flow was $50.7 million compared to $33 million in its Q4 of 2022. So if you consider cash flow from operations $85.4 million compared to revenue of $362 million, it's doing a good job converting revenue into cash flow from operations, even though it's not yet profitable on the bottom line. The primary reason for this, as we've discussed, is stock-based compensation for Cloudflare. For the full year, revenue increased 33%, so there wasn't a big difference between growth rates throughout the year, roughly consistently growing north of 30%, and the loss from operations improved to $185.5 million from $201.2 million in the same quarter the prior year. Again, improvement in the loss on the bottom line, even though they're still losing money on the bottom line. And then for the full year, cash flow from operations of $254 million was more than double the $123.6 million in 2022. Excellent growth in cash flow from operations from Cloudflare. And similarly, free cash flow almost tripled to $119.5 million from $39.8 million. So very good metrics here in terms of fundamental growth in revenue, profit, and cash flow. Even though they're still not profitable on the bottom line, they are moving in the right direction. However, all that being said, Cloudflare is trading at a forward price to earnings now of 131.8. The stock is still extremely expensive, very expensive. Despite its excellent characteristics, despite its excellent business model, despite its excellent prospects, I still feel the stock is too expensive. I feel that most of those excellent prospects are already incorporated into the valuation. Investors are already paying for that right now, expecting that to already happen. So for that reason, I'm going to keep Cloudflare stock rated as a hold. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.